Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I'm going to talk about episode 7. So I've got a few things I'm going to talk about. Particularly I'm going to talk about what to think about going into earnings season. And I want to talk about putting the odds in your favor. I want to talk about diversification and just how to think about your investments as a whole. Can you put the battery in, please, Marina? So I'm just going to help you out. So it's quite interesting here that we're going to have this episode today because we're right at the cusp of earnings season. Particularly, we're looking at small caps, which is really what I'm quite passionate about. But I follow a lot of these large caps because a lot of these large cap stocks, how they what their underlying performances tend to percolate down towards smaller cap stocks. So it was quite interesting. We're going in. So I'll just I don't know if people have been following, but Snap released some earnings last night, and the stock sold off significantly, approximately 20%. And I think it's quite interesting to talk about that because this is something that I've been talking about for a while, that if you think about it, your portfolio often will have overlapping themes that you may not really be familiar with until later in the process. I'll give you an example. So if you think about it, before COVID hit, you would have thought to yourself, okay, what does, for example, a restaurant have to do with an airline? So you might be looking at restaurant companies and you might on your mind not be thinking that it has a lot to do with an airline company. And sometimes these kind of overlaps happen that you're not really familiar, and that's the problem with investing, that a lot of times things don't come to fruition. You don't really realize how things overlap until much later. So I'm particularly addressing about Snap, but how this whole privacy issue is affecting ad tech companies. I can see that my data is buffering really badly, so I hope that it picks up my data. So essentially, I think it's quite interesting when it comes to investing, how you build a portfolio, and it really, the number of stocks you have in the portfolio determines to a large extent what type of investor you are. I've often made the case that the secret sauce in investing is how many stocks you own. That's a reflection of what sort of investor you are, and your holding period pretty much predetermines your performance. So if you have a very small holding period, let's say a few days, weeks, or even let's say less than 6 months, you're kind of just taking a bit of a speculation, and that's fine, nothing wrong with that, but it's going to be difficult not to be overcome by the element of luck. On the other side of the equation, if you're holding, let's say, onto stocks for, let's say, 10 years or so, then you're going to approximate the market. It's impossible to kind of find one or two stocks that you can build a portfolio, hold for 10 years, and that be enough to drive for the whole portfolio for you to outperform over time. So I'll give you an example. Bill Miller is reported to be one of the biggest shareholders of Amazon outside of the Bezos family. And you know that everybody knows that Amazon has done an amazing performance in the last 20 years. But even then, you look at Bill Miller's track record, and I think it's picked up slightly the last few years, but when it kind of got into cryptocurrencies. But for the previous 20 years, I don't think it went very far. So even if you have a really good idea, it might not be enough for you to outperform. So you have to think about your holding periods. That's really important. I'll talk a lot more about this as we kind of go through. But I just would like, if you want to, drop me a question so we can kind of get involved, and that's really how this is supposed to be run. This is supposed to be run for us to ask questions from each other and open up for the conversations, because it's quite an interesting period that we're facing right now. It's earnings period. I'm sure that a lot of you have interesting stocks that you're going to discuss. So please just drop me a few questions if you want as we go through. So this runs on Fridays at approximately 9 a.m. Eastern Time. It runs for about 25-30 minutes, and I do it as every Friday. To kind of give me a chance to really cement my ideas, because the more that you kind of talk about it, the more you pound it in. And it's through helping out and thinking about investing as a whole that you become a better investor. You have to kind of spend time reflecting on your trade and be able to explain it to others, and that's really when you are able to improve as an investor. So it's kind of a win-win for the two of us. For me to become a better investor, for you to see different points of view. So do feel free, drop me a question if you want. So one of the things that I want to talk about, so I'm using the example right at this moment of Snap, but this could be any stock that you like. So Snap is a company that I like very much. It's very well. Let me back up a little bit. I believe it's a high quality company. Some people don't believe, but I put it out there. I believe it's a high quality company. It's growing at a very rapid rate, and expectations for it were quite high. Now, the stock just a little bit missed the estimates, and the stock is down approximately 20%. You'll be able to see this after you've seen the video to see how it performed in the day. But ultimately, the stock is down, and it really just missed estimates by very, very little. But now the media is going to come around and is going to say, they missed estimates because of privacy concerns, and privacy. You're going to hear a lot about how Apple's privacy changes have affected Snap, and how this is going to affect the likes of Twitter, the likes of Magnite, all these kind of ad tech companies. Most likely as well, Digital Turbine, just the whole stack, Tremor, etc., PubMatic. So it's quite interesting once the market is kind of not very discerning and everyone's just throwing everything into one basket. I've often made the case to you that if you're willing to do a tiny bit more work and you're just able to sift through and pick out the highest quality businesses, provided that the valuation makes a little bit of sense, you can do quite well. So I'm not backing up the truck and buying Snap right now, but it's definitely something that's right on my radar right now, because I don't own the stock, but this is the kind of thing that I would be interested in. When you kind of invest into a business where the market is kind of caught up with a narrative, and the narrative goes one way, and the ultimate fact is the company, yes, it has slowed down and it's going to be growing at 30% next quarter. That's the guidance, 32% for next quarter. But, the problem, what's happened is that when the privacy technology changed from Apple, Snap has to give their advertisers some of their own software so that they can run analytics on how the advertisements are performing. So you got advertisers that have been for 10 years using one way of measuring their adverts, and then you're going to have some disruption, and you're going to have advertisers having to use the Apple software to go intra-platforms to measure how the success of the advert is performing and the conversion rates, and then you're going to have to use Snap's first-party advertising platform and analytics to measure how it's doing there. So this is just a bit of a hiccup, and I believe it's going to be temporary. They don't talk about how long it will be until this affects until the company returns to growing at approximately 40-50% as it has been doing over the past 5 quarters. But you want to buy when investors don't want to get involved. When investors are selling the stock because they don't want to be involved in the stock anymore, the multiple compresses. And what happens is when the multiple compresses, you're getting the ability to have 2 ways of margin of safety. First, the business is still growing at a rapid rate, 30% is nothing to sneer at. And let's say we fast forward 12 months. In 12 months, people kind of calm down a little bit. So the multiple expands slightly, but the business has also been growing at a 30 or 35% over that period of time. So the intrinsic value has grown over the next year if we go forward to the end of 2022, and the multiple expands. So you get this 2-way margin of safety that I think is something that is very, very attractive. And investing is really about putting the odds in your favor. So you start off with thinking about this type of analysis that I'm talking about, but then you have to adjust as things develop. So you have to come out with an idea. I've always said, and I say it in all my videos, whenever you buy a stock, put down 3 bullet points of why you're buying a stock. And on one of those bullet points, it must include some kind of valuation metric. It doesn't have to be a DCF, it doesn't have to be a price to earnings, but you have to write for yourself a valuation. It doesn't need to be the same as mine, but it needs to be something for you, because when things hit the fan like it has with Snap right now, you need to go back to that and you say, okay, this is what I thought. Ultimately, it hasn't changed a lot, so I'm going to be holding. Or you're going to say, no, actually, I thought this, and I can see that I'm totally wrong, and I've held the stock for a year, and I'm out. That's absolutely fine. You have to adjust. I say hold the stock for a year because I always put this to everyone. I say, if you're going to buy an investment, you need to believe that you're going to be the owner of that business for 12 months. If you're going to buy and think that you're going to sell, don't buy it in the first place. If you're going to buy and you need to hedge the position by shorting the rest of the sector, don't buy that stock. If you need to buy and you need to go buy puts and sell puts and all this, don't buy the stock. Buy the stock if you want to own the business for more than a year. If you want to be the business owner, you want to be the owner of that business, you want to understand that business, you want to grow with that business, you want to learn about the business a bit more over time, because you cannot really know a business until you are the owner of a business. You become the owner of a business by buying one share of the business. So for example, if you buy a share of Apple, for example, you'll be the owner, a proportional owner of Apple. And you'll be thinking about, okay, so how does the service aspect drive for the valuation for the business? How does that improve the margins of the business? And you can't do that as an outsider. You can kind of dig around and think about it, but once you're in the driving seat and you're the owner of that business, you'll be thinking to yourself a lot more about what's the underlying dynamics, what's the strengths of this business, what are the weaknesses of the business. You'll be going to sleep thinking about that, and you can't really do that unless you have held a share of the business. So just to circle back very briefly about Snap, I'm going to just talk about the fact that I believe, and next week, I think Twitter reports their earnings, and this is one of the stocks I own, so you'll see if I was right or wrong. But I believe that what's happened is that Snap doesn't have sufficient first-party data. They rely a lot on third-party data, and with the privacy, that's affected that stock. I don't believe. I suspect that the market will just be non-discerning right now. It'll be Pinterest. Everything is just going to go out the window when it opens at 9:30 in the US. But I believe that that in the case of Twitter, for example, I think that they have enough first-party information that they won't be affected as much. Secondly, in the case of Twitter, I've been making this case, and I'll see how it unfolds next week, that the stock is so cheaply valued because people have been catching on. The narrative has been for so long that Snap is growing their user base, which they are continuing to do. Pinterest and Twitter are not growing the user base. Therefore, Pinterest and Twitter are not worthwhile investments, and Snap is a better investment. I don't remember, you can look up afterwards, but I think that Twitter is priced at approximately 9 times forward sales, and now after the spike in Pinterest, I think it's approximately 14 times forward sale. So you're kind of getting a significant discount in the case of Twitter, so you're kind of getting that double line of margin size that I talked about. You get the multiple when it's quite cheap, and people quote on to the one sort of story, and then you hold the stock for about a year or a year and a half or two, whatever, and you get the business growing at 30% or whatever, and you get the multiple expansions. People realize, actually, in the case of Twitter, I thought that everything was about the growth in user, but it actually turns out that it's much more about the engagement, how much they can engage their user base by having, let's say, spaces, or let's having tipping jars, or let's having other ways of monetizing newsletters. So it turns out that people are like, oh, actually, this was the story that I thought, and over time the story is actually something different, and the business is actually growing at approximately 30%. So actually, I shouldn't be paying 9 times forward sales. Probably worth 13 or 14 times forward sales. So then you get that double whammy, that kind of double expansion, which is the business growing in intrinsic value, and you get the multiple expansion. So this is something that I think is quite interesting. Please do feel free to kind of drop me a question, because this is something that is for us. As I said at the start of the video, I run this every Friday at 9 a.m. Eastern time in the US, and it's a way for us to kind of engage, and I can talk to you and explain my ideas, and it's a way for you to kind of get involved and ask questions, particularly as we're going to go now into earnings season. I see there's a few people on the call, so it'll be great if you guys just ask me a question. So just one thing that I wanted to highlight as well is about this topic of diversification. So a lot of investors I see, and they kind of get caught up in this Peter Lynch idea that buy what you know and what you own. Yeah, ask me a question, Tom. Yeah, please, Tom. This is absolutely, please do ask me a question. And I'll just I'll look at your question when it shows up, and I'll just kind of continue for a moment. So the Peter Lynch idea is that you should only buy what you own, and that has been an idea that's worked out so tremendously well. And if you think about it, a lot of these consumer businesses that are very well known have become so expensively valued. There's not a lot of room for error, and they kind of pricing in a lot of many years of expectations. So it's important to be familiar with what you own. So that's where your conviction comes. If you know the business well, your conviction is quite high. But if you, for example, you have to over time as an investor adapt and learn also. So for example, when you think about your journey as an investor, I call this the 20-year journey, because the way to invest is really to think about it in this way. So you want to be, let's say if you're in your 50s or whatever, you want to be thinking that I need to do this and grow the savings for myself and for my family over the next 20 years. So I'm not trying to make quick money, a quick return over the next year or two. I'm thinking about this journey, and part of this journey is you having to learn and expand your circle of competence. So for example, let's say everyone wants to buy the businesses they own and they know, and that's fine, and you hold those businesses, but every, let's say 3 or 6 months, try and a little bit kind of discern a little bit more about the new business. So there's a question here, is Snap given an opportunity to get in? So there is a Peter Lynch quote that's on the top of my mind. The Peter Lynch quote is, don't buy a falling dagger, let it hit the floor and wobble about a little bit, and then get involved. And I think that's something that is quite interesting. I think that this is something that that is very poignant right here. So for example, I don't own Snap right now, but I'm definitely looking at it. So I would so at the moment I think that it trades at approximately 18 times forward sales. So I'm going to wait until it gets to approximately 16 times forward sales, because I've made the case in the past that if you get a stock that is growing at 30% and you get close to the multiple of half the multiple, so if the stock is growing at 30, you get the multiple at 15 times forward sale, that gives you a little bit of a margin of safety. So I think that I would wait until it gets to approximately 16 times forward sales to kind of start buying in very small dips. And the way that I do this is I put down, let's say 2.5 or 3% of my portfolio, and I wait about 4-6 weeks time, and then I would buy another 1 or 1.5%. So I'm kind of getting close to 5% of my holding period, and then I wait until after the next earnings results. I'm very much driven by the data, and I'm looking at I'm looking very much at the data of the earnings results. And particularly, if you've seen my videos before, you'll notice that I always say, whenever you open that press statement, go to the bottom of the press statement and work your way up. Look at the numbers first, because everything at the top where they talk about the headlines and the revenues and the operating metrics, it's done in a way to spin the narrative. Look at the hard numbers first, follow those through, look at the hard numbers first. And what I talked to you at the start of the video, whenever you buy a stock, you should make 3 bullet points of why you bought the stock. In those 2 bullet points, you're going to look for some tangible numbers. Try and get out some kind of, the more concrete data that you can put out before buying a stock. It's like an Olympiad. Whenever Olympiad comes to race, the preparations is on a run up to the event, and then the actual event is you buying the stock. You want to have done the prep work before you do the stock. You don't want to be kind of left, okay, how do I think this is going to unfold? So write down 3 bullet points why you're buying a stock. One of those bullet points has to be the valuation. So I've missed a few questions. What do I think about PayPal's acquisition of Pinterest? So one word that I think is odd, because I can't see how PayPal will be able to. I know the story that the analyst came out with is this kind of story about it being a family of apps and this and that, but unless you're going PayPal is going to go with the idea that they're going to go into into Pinterest's e-commerce business, I can't really see how this plays out. So I'll give you an example. So Microsoft bought LinkedIn, and we know after the event that Microsoft has done terrifically well and LinkedIn continues to grow at a reasonable rate. But PayPal, with all due respect, is not Microsoft. Yes, it's very, very difficult to go from a payment solution to an advertising business. It's not an easy business. So if I was a shareholder of PayPal, I mean, I'm like, okay, I wouldn't sell the stock on this part. I mean, I would still hold it, but it's not the same business. And Peter Lynch is on my mind again. Well, Peter Lynch talks about diversification. You kind of, just because you kind of can buy something doesn't mean you have to buy something. Sorry, there's another question. How do you value management? How much should I discount for bad management? How much of a premium? Okay, if you know, it's very difficult to value management. But if you know that the management is bad, do not buy the stock. I have been there before. I have lost too much money. Don't buy the stock. If you know the management is bad, don't buy the stock. All other alternatives are interesting, but particularly look at how much they own of the stock that you are buying. That's the big. I'm a very much of a data guy. I like narratives get spun around very quickly, but focus very much on if they own 2 or 3% of the stock. Obviously, if you have a tiny micro cap, you want them to own at least 5 or 10%. But if you have, something like Apple, they're not going to be able to own that much. So, but do look to see how much skin in the game, because that really determines how motivated they are. And ultimately, it's not so much about the management, it's a lot about the business. So I think Buffett's got a quote that when good management gets tackled by a bad business, it's the bad business that remains standing. So it's the business that matters. It's the dynamics of the sector that matter. It's not so much the management team, because there's another Peter Lynch quote that I want a business that any idiot can run, because one day an idiot will run. And you look at this with Coca-Cola and other businesses. The good business, it doesn't really matter too much, often the case, who's running the business. That being said, do try whenever possible to align yourself with business that the founder is still running the business. Because it's one thing to be a mercenary CEO coming in, being hired to do a job, and you stick around for 5 years, you try and drive the share price higher, and you dump the stock. The other thing is, if you are the founder of the business, it's your baby, you got so much of your emotion, so much of your capital invested in this business, you really want it to thrive come hell or high water. So it's really, really important to be aligned with the founder of the business if possible. I mean, I do own a stock which is Rent-A-Center, that the founder is definitely not running the business, but he is somebody that's been involved in the business in the day-to-day for 20 years. So, on the other side of the equation, this Rent-A-Center CEO doesn't own a lot of the shares in the business, but I believe that my valuation that I'm paying 12 times this year's free cash flow, not sales, and not next year's, but this year's free cash flow, I believe that a business is growing at approximately 20%, and you're paying 12 times free cash flow. I believe that this is probably giving me a bit of a margin of safety. Someone asked me about how to evaluate the businesses. This is something that RJ asked me last week, and I should have started with that. Thank you so much for asking that question, RJ. I'm so sorry that I forgot. Okay, the most important thing when you buy the business is to just look at the hard, tangible files. Look at the SEC. Go on sec.gov SEC. So I've got a file on my. Let me just see what the SEC thing is. Sorry. SEC.gov, SEC.gov, go on the filings and look at the 10K. That's the first point of view. The first thing you want to do, look at 10K and just look. So if you're on the table of contents, just look at the income statement, look at the cash flow statement. Particularly focus on this thing on the cash flow statement. So when you look at the cash flow statement, you got cash flow from operations, which is fine. That's what management wants you to look at. Spend time in the next 2 sections of the cash flow statement. So cash flow statement has 3 parts, has cash flow from operations, cash flow from investment, and cash flow from financing activities. Look at the cash flow from financing activities. That's the third part of the cash flow statement. Try to see that they are not diluting you too much in terms of selling too many shares. So that's the first thing that I'm going to do. I want to look at the business. I want to see if the business is able to sustainably grow not by diluting shares, but if the business is able to grow by potentially driving forward free cash flow. Just one more thing, the second and next thing I'll look at the balance sheet, and I just want to see how the balance sheet looks. So I'll look at how much cash there is in the balance sheet, and then I would look at the liabilities. Within the liabilities, I'm looking for how much convertibles they have, how much debt they have. And then I would do Control F just to look at the revolver. You can type in revolver, that's just off balance sheet debt. Just trying to get a gauge for how much debt they have off balance sheet. So that's the first thing that you want to do. You just try to see that the business has the capability of being self-sustained, because when, Buffett's rule number one is don't lose capital. Whenever you make an investment, the most important thing is you want to buy into a business that is growing in intrinsic value, not by diluting the shareholder. That's the first most important thing. Okay. The next thing that is very important is to look to see that the margins are quite stable over the past 3 and 5 years. So just look at the 10K that's in the SEC filings, look at the 10K, the annual. If it's a new business, it would be on the S1 filing, if it's going to do an IPO soon or something like that, or if it's coming in via SPAC. So just look to see over the past 3 to 5 years how the business has grown, and whether it's stable. Because if the revenues are very volatile and if the margins are very volatile, do not get involved with that business, because you cannot accurately predict how it's going to do over the next 3-5 years. And if you can't accurately predict how it's going to do over the next 3-5 years, I will not buy the stock from you. Because think about it that way: anytime that you're going to buy a business, if I wouldn't buy the business from you, then don't buy the business in the first place. Try to buy a business, because anyone that you're going to sell the business to, they know just as much as you do. Anytime that you buy a share and you sell a share, you're selling it to someone on the other side who's just as smart as you. So they need to believe that they've got something worthwhile holding on to. So don't be too quick to kind of go into something that is not a good investment. There's a quote, again, Peter Lynch on my mind, long shots become no shots. So try to go for high quality businesses where the founder owns the business, the founder has significant shares in the business. Try to go for stable businesses. Snap and Apple's iOS issue. Hey, great Stock Vortex, you came a few weeks ago. So I addressed this partially at the start, and I'll try and address it now. I think that in the case of the Trade Desk and in the case of Magnite, I think that these will be affected significantly in the same way that Snap has been affected. On the other side of the equation, the Trade Desk has been working quite significantly on its unified UID, unified identification. So I think that the way that its business model works, it's not so much at the exposure of this third-party privacy issue. I think that, thanks for taking notes. Yeah, thanks, that's really nice. So I think that in the case of the Trade Desk, the share price will oscillate quite significantly over the next 2 weeks or so, but I believe that it will not be such a big event, because they hold a lot more first-party data, because brands come to them and their demand side platform. So it's a bit different. In the case of Snap, they're relying much more on third-party data. So I don't believe that the ability of the advertiser to get the return on investment will be as affected. But I probably would guess that Magnite would, to a certain extent, and PubMatic and all these on the supply side platforms will be affected quite significantly. So yeah, it's been really great to be with everyone here. I mean, it's so great that everyone, I hope I have managed to answer everyone's question. Please do drop me a question later on if you don't think I've answered everything. And it's been a pleasure, and I'll see you next week, Friday at 9 a.m. Eastern Time. Thank you so much, everyone, for coming.